Hey everyone, welcome to episode 2 of my podcast. In this episode, I had the pleasure of sitting down with Ari, who is a wealth manager at the Royal Bank. In our conversation, we talked about different things that young people can do to set themselves up for financial success. Ari talks about his own journey from university all the way to his current role. He shares with us insights that he's accumulated from working with very high wealth individuals, working with families, working for people really from all walks of life. I think this episode has a little bit of something for everyone. If you have any questions for me or for Ari, you can leave them in the comments. If you're watching this on YouTube, you can reach out to either one of us via social media. So without further delay, please enjoy my conversation with Ari Mirzayan. Thanks for doing this.
Pleasure.
Yeah. I guess we can start with just tell people a little bit about yourself. Where'd you go to school? What'd you study? How'd you end up in this career? How'd you end up where you are today?
Yeah, so school, I guess I wanted to be a doctor, like every other parent wanted their children to be. So I went to Vanier in health science.
Okay.
And towards the end, I realized that I don't want to be a doctor. So when I went to Concordia, I'm like, I want to know how money works. Always interested in businesses, this and that. So I said, let me go get a finance degree. And while doing my finance degree, first year, second year, I'm like, okay, yeah, this is really what I want to be in, wealth management, investing, stocks, options, everything that involved that. So I finished school, went to RBC, and started as an account manager, pretty much built my career from the ground up. Then I became a senior account manager after a year. In the same time, I did my CFP courses to be a certified financial planner. And then in Quebec, there's an additional license you need to do with the IQPF to be certified in Quebec. And as soon as I finished that, got into financial planning at RBC. It's been about 5 years now. Did multiple regions, West Island, Saint Laurent, downtown, and finally moved to Laval. And recently I got promoted to investment advisor at RBC Wealth Management. And that's pretty much it. And I truly believe that this stage is probably where I'll be
for a while.
I don't want to say until I retire, but probably until I retire. So, and the reason for that is people often ask that question is because the way I see the business going is that I build relationship with my clients and I'm here to support them until the end. And what I mean by that is that it's not a field it's not a transition step, like when you're starting your career at wealth management, you're really there to support the families. And even if they don't have needs anymore, you go towards their children and see how you can really take them on from A to Z.
Okay, you said this kind of level is where you see yourself kind of more or less staying, you said, until retirement?
Yeah.
So I guess we could start with one of the questions that we got because it's kind of in line with where we're at right now. A question from a student was, what is a wealth manager? So maybe give us a breakdown of what you do for your clients.
Definitely. So a lot of people, when it comes to wealth manager, investment advisor, they think of it as a transactional, right? And it has to do only with investment. So I have a bunch of money to invest. What do we do with it? And that's it. And it's part of the thing, right? As an investment advisor, my goal, I manage other people's money, but it doesn't end to what the money is. So we're there to support them in everything that involves. As soon as you see dollars involved in your decision making of whether or not you should do something, we're sort of like the quarterback. So you'll come ask me, Ari, I want to have this amount of money that I want to invest. What do we do? Ari, I'm thinking about buying a house. How should we proceed? Whether you have a business, a holding, a trust, estate, anything that involves insurance needs, we deal with the accountant, the lawyers, the notaries. So it's really the whole, when we talk about wealth management, it's not just the investment. The investment is part of the equation and what we do on a day-to-day basis. But usually we concentrate on all the other factors, tax savings, and because the investments, it's actually one of the only things that I don't want to say you have little control on, but you implement a strategy on how you're going to handle it. But then the rest of the time, you're going to let the market, right, at some point, there's only so much you can do to diversify and save based on volatility. But the rest of the stuff, sometimes one small advice on, maybe we should put the bond portfolio in another account, or, maybe we should try to put the house on a different name, business, how to take out dividends. referencing all the people that you have as point of contacts and making a one decision that can change, like they'll change a small percentage of the way you were doing something, but on the long run, it might save you a lot of money and it might make your life easier. So, and oftentimes people learn about it when it's too late, and you'll probably hear me say that a lot throughout this podcast, but it's the truth. How many times have you done something because you didn't have the right information at that time, or you didn't have anyone telling you what to do?
Yeah.
And you're like, personal finance, I'll try to do it this way, we'll wing it. And then a couple of years later, sometimes a couple of months later, you're like, I should have done this. And then you're like, oh, well, too late. So the whole point is to have it in advance so that you don't end up being.
So then, I guess, why doesn't everyone have a wealth manager? Is there like a you know what I mean? Like, is there like a minimum, like, for example, a student, I imagine, does not have a wealth manager unless his or her parents have one.
Yeah.
Correct? Like, could anyone just have a wealth manager?
Yes and no. So there's no action when we deal with clients, but at the end of the day, there's only so many clients you can see, right? So by default, wealth management, when you go online on websites, on all the banks or private companies, you'll see a minimum $1 million plus, sometimes 3, sometimes 2, depends, That doesn't mean if you have 500, 400, 200,000, you can't qualify. Every person is different. The situation is different. And it's all about what we can do with that client to bring them to the next level. Unfortunately, and I admitted it, personal finance, it's something that's never really advertised anywhere. And it's so important.
Why is that?
I don't know, like I finished a finance degree, right? Yeah. And we had 1 or 2 courses about personal finance, and they're very limited to what we learn.
Yeah.
So we end up so much time learning about, let's say, I don't know, sharp ratios, p-values, stats, all the crazy finance courses about theories.
Yeah.
But then you look at it and you're like, okay, it's nice to know, but am I really using this in my day-to-day life?
Yeah.
Right? It might help you sort of trying to, let's say, build experience, the knowledge to try to get you into a job that you wanted to make more money. But once you make the money, what do you do?
So in the finance major, is there a personal, like if you're studying finance, is there a personal finance route?
I think there's a couple of universities that are doing so the only way to truly master all these subjects is to become a designated financial planner, certified financial planner, or in Quebec it's called PL.fin, planificateur financier. So you have to do 10 courses with CSI. Some universities now offer a program where I think if you do a bac or a bachelor's degree, you can specialize in financial planning and then do the IQPF exam. So the 10 courses that are offered at CSI, you can integrate it with your school program.
Okay.
You'll still end up doing the exam with IQPF, which is like a couple of months of study for our final exam. Right. And that'll give you like really, all the inside outs on what you think you should learn.
Okay. That's what you did. But you did it separate from your degree.
Yeah. So there's some investment advisors that don't have the financial planning designation because you don't need to become an investment advisor. It's definitely a plus.
But that's what sets you apart from them. They're just investment advisors who advise on investments, whereas you are a wealth manager in a sense, right? Like you have more knowledge.
Correct. So now I'm an investment and financial planner. The wealth part, when you see someone that has the wealth part in their title, is the insurance portion.
Right. Yeah.
So they can, when they're high health, disability insurance and all that.
Okay, sure.
Which I don't have that yet because it's a licensing thing, so I'm just waiting a couple of months until I do it. So hopefully by summer.
It's part of the master plan.
Exactly. So
okay, that's interesting.
So that's the thing. But to answer your question, why isn't it advertised? I don't know. But it's very unfortunate. Like, it's super important. No one knows about it. When they do, they often find out too late.
Yeah.
And small things like, people often think about these things when the time is like, okay, now I'm going to retire, or I'm 60, I'm going to work 1 more year. What should I do? Well, it's too late. It's not much we can help you on that. I can only give you a projection based on what you.
Yeah, which is why it's cool to have this conversation, because I have questions from students, right? So it's like somebody that's at the beginning of their life, financially especially. So they can maybe learn a few things. Okay, so why don't we look at the first question that I got, and it's a two-parter because 2 of the questions that came in were similar. It was about investing.
Okay.
And the student asks, what are the advantages of buying a home versus renting your home and investing? And then another student asked, so it's kind of related, whether or not young people should invest in stocks or real estate. So both questions are kind of I guess it's two questions, but they were kind of
Yeah,
related.
maybe we can sort of
So
figure out
so
a way to
maybe
answer both.
yeah, so maybe the first one. So let's say pros and cons of buying a home, renting where you live, and investing that money.
Okay. Very good question, because it's something that we always think about, especially with everything going on in today's world, interest rates, this and that. You're like, should I rent? Should I not rent? Should I buy? I would say we can answer it in two parts. There's the mathematical way, which I'll start by, and then there's another way. So mathematically, well, when people think, is it better if I buy or rent? The best way to sort of handle that situation is think about a house you want to buy. Take the mortgage payment, add the property taxes, add the insurance. That's generally the fixed cost that you're not really getting out. Now, a lot of times people compare all those three with a rent price, but it's wrong, because when you have a mortgage, a part of it is going towards principal, which is actually your money. So the real way to see if it makes sense buying or renting is to take the mortgage part, remove the principal out of the equation, so you're left with the interest. So then you have interest, which you're paying money, it's never coming back to you. You have your property taxes, it's not coming back to you. And you have your insurance, it's not coming back to you. So that's truly your fixed cost on buying. So the magic question is, if you can find that same house for rent less than those three amounts combined, then mathematically it makes sense to rent. There's no added value in buying it. Plus, you're going to be fixed with the mortgage, down payment, you're in, then you have to sell, this and that.
And risk, right? Like if something goes wrong with a rental,
You can leave anytime. You have no maintenance. You have no worries, no headache, nothing.
So that's the thing. So even if buying, mathematically, according to that calculation, you were slightly ahead, wouldn't you still kind of fall behind if you factored in, I'm going to have to fix things, I'm going to have to all kinds of like maintenance?
Yeah, it depends. Depends on, again, the price of the house, what you're getting it for. Because the other way to look at it is, if I'm going to rent, let's say a house is costing me $5,000 a month, everything in, and I can rent that same house for, let's say, $4,000, and I can invest the extra $1,000, right? That's the second part of the question that people are asking.
That's it. So home versus renting and
investing.
Yeah.
So, and the reason why a lot of people succeed with the real estate market is because it's a forceful way to create a saving strategy,
like
right?
You get your money stuck inside.
I mean, you have to pay your mortgage first of all, no matter what.
Right.
So even if it means you're not going to go out to eat at a fancy restaurant, if push comes to shove, you have no choice but to pay that mortgage payment. So it's really forcing you to save. When you're spending $3,500, let's say I'm calculating with the $5,000 a month house, if you rent for $3,500 and you're like, I'm going to invest $1,500 in S&P 500 or any index fund. I mean, because it's flexible and it's accessible, some months you'll be like, I'm a bit tight, I'll do it next month. And the next month you'll be like, I need to buy something, I might withdraw.
Yeah.
And because the liquidity factor impacts your decision making, people often get, they're off track from their target. So if you're going to ask me the question, which one has performed better, a lot of people will say, well, listen, 40 years ago, my parents bought a house for $100,000, now it's worth $1 million. If you compare it with the market, I don't want to say always, but has most of the time it's outperformed the real estate market. So had you put that money, even the down payment part of it, because when you buy a $100,000 house, people compare as if they're going to spend $100,000 in the market, which is not true, because you're financing the difference. So you're putting $20,000 in the house, let's say, financing the 80%. Had you put 20 in the market and every month the difference were renting and investing, had you put it in the market, probably you would have been better off. But were you actually going to do that?
As long as you didn't
30 years,
deviate
every single month.
Yeah, I guess that's when like human behavior kind of screws shit up.
Exactly. So it's question is kind of like a double-edged sword, because both are good. I could probably argue saying that investing has better returns based on how much risk you're willing to take in the market.
Yeah.
Right? Because if someone says, well, I don't want to go into stocks, I don't want to go into bonds, then it's a completely different situation.
Right.
Again, we're comparing apples to oranges, because real estate it's less volatile, it's more steady, whereas investing, it's the risk is a little bit higher, but the returns are greater. So.
And then follow-up question to that, I guess, in the context of investing, you kind of talked about like different types of investments, bonds, stocks, and so on. Should young people invest in stocks or real estate?
Question of preference. You should definitely do your homework on which one suits you better. Some people love like real estate. It's also, it's physical. You see it, you feel it. It's like an accomplishment. It's yours. It's more tangible,
it's like
right?
this building is mine.
You feel proud when you have real estate.
Yeah.
So people like to do that. And other people are like, no, you know what? I'd rather do it in the market. Worst case, they can buy it. That can give similar performance to having real estate, but it's more liquid. You'll get the dividends. Pros and cons of both. It really depends what you feel like doing. And also if you're someone take care of your rentals, right? Because if you have 2-3 properties, it's not just having the properties and, okay, I get this much rent, this much property taxes. There's maintenance involved. People will call you dealing with tenants. Someone wants to leave early. Someone doesn't pay. Plus you have your full-time job. Not everyone has the stomach to deal with that. Like I know plenty of people that bought real estate and after 2 years they're like, nah, not for me. Sell it, dump it. I'll get my money out. And some people love it. They grow to 7, 8, 10 properties. They get property managers. So both strategies work. Leveraging is a good part about the real estate that you can do. Wait a couple of years, refinance, buy something else. So
what about, so someone else asked a question that's still kind of related. The best way to invest in real estate if I don't make a lot of money yet. And you talked about the REIT, right? Mm-hmm. I'm guessing that's one strategy.
It is. You're pooling yourself with others to try to get the same returns. So when people ask me, I don't make a lot of money or I'm young, I'm starting to do in real estate, what should I do? Well, at the time that you want to make the decision, the best thing, you get a pre-approval. You have to start with a baseline. So it doesn't matter how much you make, 30 grand, 80 grand. Let's say you make 50 grand. Go to the bank, you have no debt. Bank tells you, you qualify for, 200,000. So there you go. That's the best you can do given the situation. You have your 50,000 down, let's say, or 40,000. You buy a $200,000, you get a $200,000 mortgage. So your goal right now is, once you have the pre-approval, is to try to find the best property that you think is worth more than 250,000, but it's going at a discount. Right? Because the bank told you already what's the max they can finance you, and there's really nothing else you can do to increase that amount. You can shop around, try to get maybe 10, 15, 20 grand more from one bank to another. Your goal really is to try to check which one is going to give you potential.
Which property?
So
okay, so I'm 23 years old. I have, 40 grand. Yeah. Right, so 20% down on a $200,000 place, and I qualify. Am I better off buying a $200,000 property with my 40 grand, or putting that 40 grand into a REIT?
Again, depends. And you're going to see me do this a lot in this podcast also, is I'm going to ask a lot of questions. Yeah. Because a lot of people, when it comes to any decision making, they just get an advice, whether it's in real estate, whether it's in insurance, whether in investing. Someone told me to do this. Someone told me to buy TFSA. Someone told me the RRSPs are a scam. Someone told me life insurance is a scam. And it depends from person to person. And the best advice that I can give you is, if you receive an answer and you realize that that person didn't ask you a million questions, chances are you're getting the wrong answer. So, for example, like investing. I wish doctors would ask you questions. Yeah. Instead of just like prescribing something. Yeah, or they just look at you and they're like, this is what you have. Yeah, it's kind of the same thing, right? But in finance. Okay, that's interesting. And it's true, because there's a million things that can impact the decision. Yeah. And that is why people, they regret their decision when they look at it 10 years from now, because they're like, I just wanted to do this. No one really asked me why. No one questioned my. People are there for transactional REITs, right? I want to buy a house. Here's this. It doesn't matter why you want to buy it. Right. So, for example, let's say you said you're 24. You have 40 grand. Should you buy a REIT? Depends which REIT. Taxations of a REIT, dividend income, versus when you're going to compare it to buying a property. Are you planning on staying here for the short term or long term? If you tell me, 1 or 2 more years, then I might leave the country. Well, why lock yourself up in a real estate? It's more of a hassle to try to get out, especially based on how the market performs. People often confuse with the latest 3 since COVID. They think that they're going to get 25% annualized return on their real estate, which is not true. That's only one part of history. So it depends. And any questions that should I do this or that, I'm probably going to answer with it depends on multiple factors.
Like I have that 40K, and like the typical REIT yields what, like 6-7%.
You can find 4, you can find 12, depending on risk, right? So. And you're only dealing with the 40 grand. So sometimes people will come and they're like, I'm young, I have the time and the energy to work on. I'll buy a property that's worth 240,000, but I'll get it at 180. You know, put the time in, do the shopping, speak with real estate agents, and then they're like, I'll renovate it a bit and try to flip it. So overall, the amount of money they spend, if they can flip that to, let's say, at 300,000 and they bought it for 180 and they spend, I don't know, 50 grand renovating.
Yeah.
Right. The percentage return on their dollar investment might be higher. Now, how often are you going to do this? It's another question. How long do you want to do it? Another question.
So basically, if I understand, if you're willing to, you know, roll up your sleeves, look for that property, go in, fix the property, you're probably better off buying a property versus the REIT. And if you don't really want to do anything, you just kind of want your money to invest, or you don't want to invest it for too long, buying a property would be the wrong decision, maybe tying it up.
Depends. And again, who said that I need to invest in a REIT, right? That's only if you want to compare kind of similar industries.
Right.
There's
exactly.
there's many other things that you can invest in.
Yeah, I guess if you're putting your money in a REIT, you could just put it in any other stock.
That's it. So mostly people put it in a REIT, let's say if they want to diversify their investment. So they're like, you know, I have some money, but I also want to be involved in the real estate market, but without actually having to buy real estate. So they end up doing that. Depends. Endless possibilities, but
that's interesting.
Case by case.
So then, what about interest rates? So obviously right now that's kind of like a big thing. And everyone, I mean, just from like driving around my own neighborhood, doesn't look like very many houses are moving, right? So everyone's kind of sitting, waiting. Is it, so a question from somebody, you know, should I buy a home now given the interest rates? So I guess you can maybe talk about I'm sure there are some pros of buying right now. And obviously the cons being that's going to cost you way more. So what's the advice that you give people asking you that question? Because I'm sure you get it, right?
Yeah. So my clients, when I get it, it's usually people trying to downsize. So they're like, I'll sell my house, buy a new one. So for them, right, they're selling and buying. So the market doesn't really matter if they're paying a premium or not, because they're also selling one.
Yeah.
So they sell for more, they buy for more, they sell for less, buy for less. But for someone who doesn't have a house, like it depends. Like, do they need a house, or are they just thinking about buying a house as an investment?
Yeah, I guess maybe like somebody who's moving out of their parents' house, or maybe a young family that's moving to a second house that's bigger.
Yeah. So I'm going to answer the question with someone that really needs to buy it, not someone that is thinking about buying.
Right, exactly.
So, I mean, if you need a house, yes, you should do it. But the way I look at things is, let's say pre-COVID, right? Pre-pandemic, when everything started to happen, the rise of the property values, interest rates were like, you know, variable, I think was under 1% with some of the banks at 0.99. So people had much more leverage in terms of the borrowing amount that they were able to get from the banks, right?
Right.
And because there was so much demand and not enough supply, you were selling your house for 700 grand, and then someone will come out for 750. Oh, I qualify for 8. Oh, I can qualify to 850, and I'm still within my means. So they did it. Was it a bad thing? It depends, because right now, if I'm looking for a house and I see that house was sold for $1 million last summer, but now the interest rates are 6%. Even if you give me that house for 800, I probably won't qualify, even though I did a couple of months ago. So I'll only buy it if it's within my means. But then the question comes, is it worth to buy if the rates are 6%, or should I wait? That's only temporary. So even if you locked in a rate at 1.5% last year or the year before for 3 to 5 years, and you'll be like, you know what, I paid $200,000 more for my house, but I have a lower rate than even if you buy your house now at 6%, you're being screwed. But what if rates stay between 4 to 6% and your house comes for renewal? Right? Your only true benefit of having the low interest rate is only until it comes to maturity.
What's the stat on that? Like, how many people are going to have to sell their house?
I don't know. I don't know the
Probably
stats.
A few, right?
I mean, think about it. You were paying $2,000 a month, and now it's $3,000 or $3,003.
Yeah. So let's say somebody bought a house for I don't know, like they bought a house for $700K, and they got the 2% interest rate or 1%. Mm-hmm. And 4 years from now, they're going to renew at 7%, 6%.
Who knows, right? But it's going to be like
the mortgage payment is definitely going way up, right?
I mean, think about it. From 1 to 5, you know, it's a 500% difference.
Yeah.
Right. So people don't look at the percentage. They're like, oh, it's only 1%. Meanwhile, 1 to 2, it's double the interest that you're paying.
Yeah.
Because it was so low, it was marginally low. So people were like, oh, 1%, 2%, whatever, I'll go for it. But now when it's 6, it's not everyone that has 2,000, 2,500 more a month to pay for their mortgage. No, most people still live paycheck to paycheck. So at that point, your mortgage comes for renewal, and you're like, well, I'm either going to figure out a strategy to spend $2,000 a month less to pay the mortgage, or I'm going to sell it.
Sell my house.
But even if you sell your house, you're not getting top dollar for it, because people know that interest rates are 6%. So the best example for this is, say you bought a house for $1 million last year, and that house was worth, prior to the increase, let's say it was worth like 700,000, right? So you bought it for $1 million, you were paying 1%, and let's say you took a 1-year fixed rate, right? So now it comes to maturity, and you're at 6%. So what do?
You're screwed,
right? If you sell that, no one's gonna pay you $1 million.
No.
Because even if I was ready last year to buy that house for $1 million at 2%, right now, with my income level, I don't qualify more than 750. So even if you give me for 8, I can't buy it. I want to buy it for 8, but I don't qualify. So either you're going to wait until someone who has money says, you know what, I'll buy it for at a certain price that you agree on, which is going to be probably less than $1 million, because they know the market, or you're going to whatever's the highest offer.
So then wouldn't the strategy be for somebody who's trying to invest to wait for the dominoes to start falling?
There's a lot of people who have a lot of cash on hand, right? During recessions, cash is king.
Right.
So because you can buy anything you want without having to borrow. Because even if you have borrowing limits, you're paying the interest rate of 6, 7%, 8%, depending on prime plus whatever you're paying. So people who have cash will definitely, kind of like the 2008, 2009 crash, you're buying at a very low price. So your gains are exponential on the long run because you bought it at such a low price. But it's not everyone. During a recession, people are already very tight on their budget, and it's very difficult to save because you're paying so much for groceries like IGA. You can't get out with $50 anymore.
Yeah.
So I'm sure you know that too. So it's just, savings is difficult, but at the same time, cash is king. So only people who have the most amount of money saved are going to have the opportunities to buy properties, stocks, anything that's an asset at a low price.
Like a crazy discount.
Yeah, and the people who have money who want to buy real estate, they're not going to pay you top dollar for it. They know what they're doing.
Right.
So hopefully, if you had those low rates, you locked them in for a long time, because the longer you did, the more you're going to save. And hopefully, by 5 years, rates will sort of come lower to 2 to 3%. But if they don't, think about it. You bought a house for $1 million last year, and I bought that same house for $800,000 this year. And in 5 years, when both of our mortgages, let's say I took a 4-year rate, you took a 5-year rate. So in 5 years, they both come to maturity.
They're worth the same thing, right? The houses?
Both houses are going to be the same. Now, did I pay $200,000 more in interest payments in those 4 years? Probably not.
Probably not.
And I'm used to paying the 6%. So you're going to be more of a shock. So when people say, even though I paid more for the house, I'm saving on the interest, you're not saving on the interest for 30 years. In the States, that's true, because they can lock in a 30-year mortgage. So that's true savings. But not anymore. Not in Canada, I mean. So, and again, it depends. Some people might be better off. It depends on what you're paying for the house. But there's counter arguments for both sides.
So say I really need to buy a house right now. Okay, we don't know interest rates are going up or down. Would one strategy be to take a 1-year fixed at this point, because like how much worse can it get, and just reevaluate next year?
So when I had most of my clients that the mortgages came to maturity, I advised the 1-year fixed, because at some point the 1 year was the same, if not even lower than the variable. So I'm like, the rate is the same. I know for a fact, probably rates will go up 1 or 2 times more until next year. So I suggested they take the 1-year fixed. So let's say the 1-year fixed was, 5.5, and the variable was 5.5. And every time it went up. So now their 1-year fixed is lower than the variable. And by next year, by the end of this year, if rates are still high, we'll see. But if, based on how the Fed is handling the situation, if they say no more rate hikes, which is also what they said pre-COVID, during COVID, they're like, inflation is transitory, no rate hikes at all in 2022 or 2023.
Yeah.
And they increased it like 6 times at 1%, 0.75%. But yeah, I told my clients 1-year fix.
Right.
And we'll see when things go up.
So that's it, right? Like at this point, locking in a 5-year mortgage is pointless. I mean, not pointless, but like
a 5-year fixed.
A 5-year fixed.
I wouldn't suggest that unless someone really wants to not have any volatility.
Like completely eliminate your risk, I guess. But
because the risk reward isn't that anymore, right? When the rates were around 1%, could they go lower? Maybe. I mean, historically they were record low. You could have said that when they were 3 and then 2. But at 1, it's like, okay, we know they're low, and we know based on everything happening, chances are they might go up. So the risk premium was there. You take the 5-year fixed, even if the rates go down a little bit more, it was worth it.
Yeah.
And the same thing now, like you
kind of
hear from the news, they're like, maybe they'll increase the rate one more time. That's about it. So locking it at 5-year rates at the peak of the market, probably not.
It's kind of like buying high, selling low
ish. Exactly. So I'll try to stay with the variable or take it 1 year fixed at a time and see how rates go.
That makes sense. That's interesting. Okay, so we talked a lot about real estate.
Yeah.
A student asks, what can a student with very low income do to set myself up for financial success in the future? So very low income, that could mean that they have a job that doesn't pay them much. That could mean that they have a lot of expenses, but they have very low, I guess, income in a variety of ways. What can they do? What can a student do? I guess most students have low income, right? So what can students do? What are things that they can do to set themselves up so that when they finish school and then maybe get 2, 3, 4 years into their life, they've got a good financial foundation?
I think that's a question that we all asked at some point in our life. You're working, you see things on TikTok, on the news, YouTube, all these successful people, and what should I do to try to get ahead of the game? And it's not easy, right? Like, I'm sure I think we're both people that, we pretty much started from nothing. We built our careers to where they are now. And there was at some point in your life that you were probably making minimum wage.
Yeah.
And, you try to figure out strategies on what to do, And the main thing about this question is that people often tend to refer as the stock market. You'll see a TikTok about someone saying how they're day traders and they can make $5,000 in a day with, $200. And
that's all bullshit.
It's very rewarding, right? So you're like, oh, there's got to be something true. I see the cars, I see this, I see that.
Like, how much of that is legit?
Listen, successful day traders are less than 1% of the population. I've actually the people that trade. Not even the population.
So 1% of the people that
1% of people that trade are actually successful, and that's their full-time job. And what you see is that trade part-time, make $5,000, this and that, because someone did it at some point in time. Did they successfully do that for the past 10 years? Probably not. And the people that actually do it, there are people, but it's a full-time job. It's their career.
They're probably not making TikToks during the day.
They're not making TikToks during the day. So let's put it this way. Minimum wage or your student low income, let's say you're making, I don't even know what the minimum is, 15, 18?
I think it's going up. It's probably like $15 or something.
Yeah, let's say you're making $15 an hour, right? And assume you're working full time. Okay. So if I were to pay all your expense, all your rent, your car, your gas, everything, the maximum you can save is $15 an hour, which is what, $120 a day if you're working 80 hours a week.
80 hours. Yeah.
That's the max you can spend. So when people say financial success, having a lot of money, if I have a lower income job, Elon Musk actually had quoted that it's much easier to make $10,000 than to try to cut $10,000 of spending. So at some point, you're like, oh, I shouldn't go out. I shouldn't do this. It's much easier to try to figure out a strategy to make more money. So when people ask me, I'm on minimum wage, I have a low income, what should I do? Investing is more of, I don't want to say capital preservation. You can definitely make money out of the market, but when it's marginally low, when you have when you have $1,000 to invest, you can't rely on that to make a living out of it, right? It's not going to create your wealth.
Even if you make 100% return, it's $1,000.
That's it,
Yeah.
So, and even if you save all your money, which is not true, and that's if you're not paying any income taxes on it. Even if I pay your income taxes, the max you can spend is $120. You can save is $120 a day. So, trying to find a strategy, whether it's education that's going to give you, starting your own business, being an entrepreneur, all those, you should concentrate on how to generate more money. And then we look at options on how to invest to see what's going to, that doesn't mean you shouldn't invest when you don't have a lot of money. It's just when people think about financial success, definitely work on increasing your income. if you're making $15, $20 an hour, chances are you're spending at basic essentials, right? You can't really cut food, you can't really cut rent,
Right.
can't really cut hydro. If someone's making 300 grand, and if they want to save $20,000, they can say, you know what, I might not buy those fancy shoppings that I'm doing.
Yeah.
But when you're, it's a different story for them,
Yeah.
right? So concentrate on making more money. Even if you work double time, if you get a second job, and if you think that, oh, I'm working more, it's much easier than the alternative solution, which is not the money.
Would you say that it's a good advice to a student who's asking a question like this? What can a student do with very low income to set myself up for financial success? To, instead of worrying about, what can they do with that low income right now, to focus on either, like you said, make more money by taking a second job,
career,
but even like education, right? Like educate yourself on personal finance, on what to do with money when you have it, so that when it comes, you don't make those mistakes.
Definitely. And like I said, it's not that you don't really see. So if you don't put in the work to try to educate yourself, even in school, like we graduated in finance, accountant, no one's going to actually teach it for you.
Yeah.
So
because a financial foundation doesn't literally mean like you have to have a lot of money. It could just mean having a base of very good knowledge of finances, so that then you can make the right decisions on top of it.
Exactly. It's understanding the products and services that are out there. So whether it's investing, whether it's mortgaging, knowing how the banking system works, right? You don't want to show up to a bank and then you didn't position yourself in a way that you're going to get qualified for this, right? A lot of people come and they're like, oh, I want a house this, and they've already maxed out their credit facilities, not much savings, like, right? You don't want to go to the bank and then they tell you no, and then it's going to take you a year until you start doing that. And timing is a huge difference. Like you'd be surprised the amount of people that buy a car right before applying for a house, when they could have done the same thing a month later after they qualified for the house, and it would have been the same thing.
Changes everything.
And I don't blame them. They don't know, right? It's not like they know and they're doing it. It's just they don't hear it.
So by buying the car before buying the house, now I go apply for the mortgage and they say, oh, you don't qualify because you have this car payment. Whereas if you had done it the other way, chances are you would get the car payment.
Because the car payment, they're much more lenient on the qualification process. A mortgage is not. Right. So you have $1,000 a monthly lease, and your mortgage is $2,000. It would just, if you were qualifying for 300 grand, you just lost half, because you're paying the equal amount in terms of your car. But had you bought the house first and then maybe shopped for the car, even if you don't get the car, which one's more important to you, the house or the car?
Yeah, for
sure. Things start to add up. But yeah, I mean, educate yourself. That's especially in the finance world.
And how could a young person who's, let's say, not majoring in finance, right? General young person, how can they educate themselves? Like, what are like, if they don't want to do a finance degree, they just want to learn, like, are there courses they can take? Are there resources? Like, what would you, if I'm 22 years old, I'm a fine arts major, but I want to learn about personal finance. Like, what do I do?
A lot of times people forget that there's a bank, right? And I don't want to say all financial advisors are the same, because they're not. Find yourself a reputable person, or whether it's a word of mouth or a friend, someone that they deal with, or if you know someone who deals with the current advisor that they're satisfied of, ask them, I want to learn about this. And even if you're not actually my client, that doesn't mean I can't give you the advice, right? Like RBC, everyone that works in the branches pretty much know what they're doing, right? So you can go and say, this is my plan. I don't want to do anything now. What do you think? And they'll tell you based on what their advice is. So even if you actually haven't studied for it, we are here for that, right? My clients have not studied personal finance. They trust me on their decision making. So that's why I do what I do. I've seen so many people regret their decisions, learn about all these things that they can't, it's not their fault. And I see them ending up when they are, and I'm like, we could have done such a difference had we known things in advance. Yeah. And that is why I do what I do. I like helping people achieve what they really want, their goals. It makes all the difference.
Yeah, for sure. I mean, I do that with students, right? So helping them achieve their academic goals. So
and you see the difference, right? Like you see where they came from and where they're up to now, and all that because of an advice. It's a huge accomplishment.
You find that like fulfilling?
Absolutely, because especially me, it's like when you get involved in families, you know, generational wealth, this and that. Like you'll get to understand how people. Like my clients are almost my friends, because you get to know them at some point. It's like we know each other. Sometimes in meetings we don't even talk about financial stuff. So kids, family, this and that, what you plan on doing, vacation. And then towards the meeting, we have like 5 minutes. We'll have, okay, like, let's look at the financial reviews, you know? So
that's interesting. I feel like every family has a doctor, every family has a dentist, every family has a lawyer, accountant. Every family should have a financial manager, wealth manager.
They should. They definitely should. And like I said, it's a question of trust, loyalty, and competence.
Yeah.
Those are the three things that I believe in. Because no matter how good someone is, if you don't connect with them, if you don't trust them, even if he might give you the right advice and you're like, I don't feel that he's really valuing me. So find someone that you can connect to, that's honest, that has a reputation, that has a track record. And really, it's kind of hard to lose.
So another question a student asks, should I open an RRSP if I'm only 20, or should I put my money in my TFSA?
Again, multiple ways to answer that question, but the main idea behind an RRSP is that you're trying to put money in an account to get a tax credit, so that eventually one day when you withdraw it, you're still going to pay taxes, but you're trying to change brackets or shift brackets. So for example, someone's making $200,000 today. They'll put, 20 grand in the RRSP. So let's say their marginal tax rate is 50%, just to make round numbers. So if they put 20 grand, the government's going to say, oh, listen, here's 10 grand back since you've already paid taxes on this. And the idea behind it is that 20,000 in 20, 30 years when you withdraw, which chances are is going to be during retirement because you stop working. Well, if during retirement you're making 70,000 and your marginal tax rate is 37%, so you just saved 13% in terms of the tax bracket change, plus the interest and the compound interest that you've made throughout the time that it was invested. So you're saving in terms of brackets, the percentage shift, plus you're making money in terms of what you made on the investment side. But a lot of people confuse and they think that the RSP is only for retirement. I'm still young. I don't want to lock my money until I'm 60. And it's false, because you can withdraw the RSP anytime. It's not locked, right? The money that you're putting in an RSP account, it's voluntary contributions. So let's say in 10 years, you're 30 years old and you decide to take a year off work. You're going to change industries, or you decide to travel. That's a perfect year to withdraw from your RSPs because your income is zero. So again, it depends on what your situation is, but the money is not locked until retirement unless it's a company pension plan, which is totally different. And the idea behind it is that you're trying to pay less taxes, or in some cases, people defer the taxes. You can look at it any way we want, but there's definitely savings. And I think sometimes people also ask the question of, should I invest in RSPs versus TFSA? It depends. If you're 20 and you're telling me you're making $35,000 a year, you're working part-time, then no, you shouldn't invest, because chances are your marginal tax bracket is so low that there's no benefit in putting money and saving it on that year. It's better if you wait on a year that you're making more money, put it there, and see how it goes. Like if you just graduated university and you have a job that's paying you $40,000, and within the next 2-3 years you're gonna hit 80. When maybe it's better to use that deduction in the year that you're making 80,000. Because your tax savings is going to be much higher.
And you can carry forward the room.
And every year that you've worked out, you're not losing it, so it's carried forward. So you can actually even put money in an RSP and not claim the deduction if you want to just invest it in terms of the tax-free growth. The problem is when you withdraw, it's going to be taxable. So I would say someone who's 20 and is asking that question and has a low income, I would suggest TFSAs. You have more flexibility and you still have the tax efficient growth, and when you withdraw you're not paying anything, whereas RSPs, the year that you're going to withdraw, it will be taxed based on your tax bracket of the year,
right?
And if you're 20, it's you're making 30-40 grand, probably not the best idea, because you're going to save a very small percentage. But then there's another point, people that say, well, at 25 I want to buy my house, so I want to use the first time home buyers plan, which allows you to withdraw, let's say, $35,000 per individual to use it for your first house. So again, depends. We would have to look at your income, your goals, what you want to be, when you plan to do it, and see which one is the most efficient.
Right. That makes sense. So For the first time home buyers, that's, I mean, would it make a difference? Like, if I open an RSP at 20, when I'm already in a low bracket, I guess it probably wouldn't make that much of a difference if I would do that or just put that money in a TFSA and use it as my down payment.
Yeah. So if within the next 3-4 years that you're trying to save, you're making, let's say 30,000-40,000,
probably not much of a difference.
It might be better putting it in a TFSA. And in case you don't end up buying the house, well, you still have the money in the TFSA. Or in some cases, what we suggest is that because the money has to be in the RRSP 90 days before it becomes eligible for the first-time home buyers plan. So you'll put it in the TFSA, start there. And if you decide to buy a house, you dump it in the RRSP, and within 90 days, you can withdraw. That way you get, hitting two birds with one stone.
Yeah. Okay, that's smart. That's interesting.
So, yeah, that's how I would handle it.
Okay, so this next one is a two-parter, and it's what are some financial mistakes that young people make? And then on top of that, and what are some common things that successful people do?
Okay. Biggest problem with that common people make is just the borrowing facilities, like a good advisor should not only concentrate on the investments, they should really look at the overall picture and see what's wrong. Like you'll see people max out RRSP TFSAs when they're loaded with credit card debt. Like they're paying 22% interest and they're trying to maximize their saving. Like at 22%, it's the worst debt you can have. If you make 40 in the market, you're breaking even net, and no one's making 40% yearly returns. So, and it's taxable. So pay your non-deductible, interest rate, whatever is being charged on your credit card, and then start. And it takes a lot to say that to someone because they're trying to save and you're like, no, don't try to pay the debt first. But it just makes sense, right? Like think about it. In the next 15 years, if you're dumping money in a TFSA, earning 8 to 10%, and you're paying 20%, you're negative every year.
Yeah.
The math will never add up.
Paying your debt is like a guaranteed return.
Exactly. Guaranteed and immediate, and it's costing you double, and it's draining your cash flow. So pay the debt, and once you finish paying it off, start investing.
So do young people like get a lot of debt early on? Is that
Yeah, most of the time that's what we see. They've used their credit card substantially. The whole point of a credit card is to get points. Transfer the liability in case something happens. It's on your credit card. But you should never really use it more than what you have in your checking account, right?
Right.
Unlimited transactions, you get all the benefits, but pretend it's a debit card. Just use it as a credit card and pay it at the end of the month. All of it. It could be you miss 1 or 2 months, maybe for a certain expense, you want to wait a few paychecks. But the goal is to make an immediate payment and pay it off as fast as possible. Like mortgage debt, I'm not going to compare because that's totally different. It's backed by an asset.
Right.
Lines of credit are also different. When you're having, self-employed people use it a lot because their paycheck is variable. They don't always have the consistency. So they might use like 10, 20, 30,000 up front, but they know there's a big paycheck coming up to clear it. So it's more of a revolving credit to finance a lifestyle. Some people do it for renovations, but the interest rates are much better. They're not like credit card debts. And another mistake people make is buying a car that's equal to their monthly net payment. Like they barely make the payment of the car plus insurance plus gas just to drive the car.
Yeah.
So it's tempting. You're young, you're starting, you get a salary, you're living with your parents, you want to drive a nice car. But you just have to have the common sense to think about the future. And I'm not saying like 20, 30 years for retirement, right? When we're young, no one thinks about retirement, but you should know that it's there. Like you should know the things that can be exaggerated if you make a mistake, and the things that, it's more lenient. You want to go party or spend big money on one purchase, it's fine. But to do it consistently, that's what the car payment is doing, right? $1,200 a month. People buy cars at like 20 years old for the next 5 years on something that's going to lose money. If you're not thinking about that, then at some point you're just going to do it again and again. And after 10 years, you're like, shit, what did I do?
Yeah.
So, and I know it's hard to just like, people will look at it and are like, oh, forget it. One life, YOLO. I want to live my life. mean, you should do it, but up to a certain extent. You should, balance is key, and not a lot of people know that. So, and I'm not saying you should, save every dime and invest for the future. No, I'm actually a firm believer that you should enjoy your money. Most of my clients who are approaching retirement, I always tell them, like, if you don't find the balance on doing the things that you've always wanted to do, 60 to 75, once you get older, health conditions come, life changes, there's other needs. Even if you have the money, you won't be able to do the things you've wanted to do. Like, I have clients who have millions of dollars. They're 80 years old. Like, I have one client who, and his wife wanted to buy the new, like, I don't know, I think it was a RAV4, like the new one that came up, heated seats, leather, everything. And he was driving like a 2005 Camry. So he goes, we went to the dealership. My wife loved the car. And they have like, $3-4 million. And he's like, do you think it's the right time for me to buy the car? And I'm like, it doesn't really matter at this point, because even if you pay it all cash, instead of 4 million, you're going to have 3,999. And until when are you going to wait? Like, having the money is nice, but you don't enjoy it after some point. And that's exactly, and I asked him the question. I said, wouldn't you rather have spent, let's say, 2 million when you were 50, 60, 70, and had maybe 2 million less now, or maybe 2.5 million less because you'll have less money invested, but at least you would have been able to travel. You would have been to buy the thing. Driving a sports car at 80 is not the same as 60. It's not the same as 40. Yeah. So balance is key. And I'm not saying spend all your money and just, don't have enough. But don't just be those people that just save every dime. They at the end, they pass away and they couldn't enjoy their money.
What's the thinking there? Like, why aren't they spending? You know what I mean? Like, if you get to 50 and you've got millions saved up, at that point, like, why aren't they spending it?
So some people, like, you should do what makes you happy, right? You'll see people living in a $3 million house and driving a $30,000 car, right? There's nothing wrong with that. If that guy is happy, if the car doesn't mean anything to him, then he shouldn't buy it. He's someone that loves a house or loves to travel. You'll see people traveling and they have a smaller car, a smaller house. And then you'll see people who have Ferraris in a $600,000 house. As long as they're balanced and they have enough to maintain their own lifestyle, that's what they need. So if they're happy doing the things they want, I have no problem. My goal is to make them achieve their goals, not my own goals. And there's no right or wrong. But the problem is you'll see often people that actually want to do those things, and it's sort of engraved in their mind that I cannot spend my money because I won't have enough. And that's where a financial plan comes in handy. When I project your current value and your current net worth based on everything you want to do in the next 20, 30 years, and we usually do these, when people are transitioning to retirement or they're thinking about that, because the values are more correct. Right? If I tell you I'm going to make a financial plan at 20 years old, well, any assumption you give me is probably going to be incorrect because you don't know what the future holds for the next 20, 30 years. But once you're approaching retirement and you're not going to work anymore, you've saved up X amount, you have a pension plan, we'll generally get a good idea of what it's going to be like. And if you have enough to achieve everything you want to do, you should definitely do it, because you don't want to be that person that's going to die and it's going to say, I've always wanted to do those things. And unfortunately, I did have enough money to do them, but I always thought I wouldn't. Like, there's people that live extremely conservatively because they think that if they live another 20 years, they'll run out of money. And when we do the plan, they're like, you're going to live 20 years, do the things, and you're still going to die with $1.5 million. And when they see it, like, people are visual. So when you see that statement and you're like, holy crap, like positioning someone, and you'd be surprised, like, the amount of people who think they're poor, meanwhile they're in the top 5%.
You have a lot of obviously very wealthy clients, and you know them personally. So then, what are some common things, actions, traits, characteristics that they have in common? Yeah, like what that contributes to their success.
So most of the clients, when you're dealing with high net worth individuals, right? You're not the person that made that money to them, right? You didn't invest the money and in 3 years they became a millionaire.
Right.
They know how to make money. They've made their wealth. They're coming to see you because they don't know the other side. They know how to make money, or create businesses, sell businesses. And now they're like, okay, what do I do once I'm not in the working field to try to keep my lifestyle, maximize on taxes, maximize on returns, balance everything out in a way that's going to be sustainable for the future. So a lot of advisors think that their goal is to generate or like make money for their clients in terms of a business. And it's false. Like if you're an entrepreneur and you have your own business and you made money and everything, and you come see me, you're not coming to see me to say, oh, listen, Ari, here's $1 million. I want to make, 70% annual returns out of this. That's not the point. And what I realized that all of these people have the thing that they have in common is they're very good listeners, and they'll make sure to get the best advice. And what I mean by that, like, they don't mind hiring a professional, paying for expert advice. That instead of doing the research on their own, they'll go see someone. They'll go see a lawyer. They'll go see, a notary for a specialized thing, estate planning, financial planning. They'll go see the best of the best to make sure that their money is protected and to make sure that it's going to align with what they want and to deal with someone they trust. Because a lot of times, especially with Google now, you can Google a few things. There's AI that's coming into that. Younger people tend to believe that they know everything better on their own, and so did I, until they find out that they didn't.
Yeah.
So, and it's different when you don't have a lot of money at stake, because you're like, okay, what am I risking? If it works, if it doesn't. But when you have millions of dollars, or even hundreds of thousands of dollars, at some point you're like, what am I risking this for? Like what's my added value of me doing it on my own, or to get a professional to do it for me? And I think that's what's common in all of it.
If they need something, you're saying that they hire consultants essentially for everything. Yeah. Experts so like you, for example.
Yeah. And where we come in handy is that even if they don't know the rest of the people, we do. So the whole point of wealth management is to have one person, like I said, as the quarterback, and anything you need, like you can need house insurance, you can need life insurance, you can need loans, mortgages, business loans, any credit file, any business account, trusts, estate. What should I do with leaving the money to my kids? What if something happens to me and my kids are young? Setting up a trust. Anything you need, we have the people for it.
Yeah.
So, you have a go-to trusted advisor, and you'll know that if I ask him anything, even if he doesn't know the answer, he'll figure out the answer. He'll bring me in contact with the right person.
So you're like the family doctor of finances, and you're going to refer them to an expert. If they need a mortgage, you're not going to give them the mortgage, but you're going to refer them to a mortgage specialist who's going to do it.
Yeah. And I think that because I started from RBC, I built my career from the ground up, and I've done all these roles, I can literally have the entire conversation with my client because I know what it's like. I've done these roles again. So it's not like when a client asks me a question about a mortgage or about a loan or about a business account, I'll be like, oh, I have no idea what you're saying. And I can kind of relate because I've done it.
Yeah.
But at the end, I'll still refer to the specialist who only does that. Because when you study financial planning, you're kind of like the generalist doctor. I don't want to say a little, because we know a lot about a lot of things.
You know a little about a lot?
I know a lot about a lot,
okay.
But still, it's different when someone only does, let's say, mortgages,
right.
Only does investments,
right.
Only does businesses. So, and we work as a team. So when clients deal with me, I introduce them to the whole team. Even banking accounts, every day there's daily changes in terms of fees, structure, this and that.
Yeah.
So we work as a team, and I think that's the difference. It's when you're working alone, you're limited. Whether you like it or not, there's a maximum amount of clients you can serve. There's a maximum amount of things you can do. So okay. So
let's say I'm 35 years old. I've saved up, or I just sold my business. So, I have $1 million that I just made from that, or $5 million, whatever amount. Yeah. And up until that point, I haven't had a wealth manager, but now I imagine that I would need one. How what would be the best way for somebody to meet a wealth? Like, how do you walk into the bank and say, I need a wealth manager? And then what happens after that? Like, how do I know that I can trust you to manage my funds? And, what if, I hire a wealth manager and, I'm not feeling it. Like, how, you know what I mean? Like, am I locked to this wealth manager? Can I move to a different one? So let's say I walk into a bar and I meet you and I'm like, hey, I really want you to manage my money, but my money's with someone else. Like, How is that transition something that's easy?
So yeah, that's a good question. So obviously you're the client, right? You can choose whoever you want, even if the money is managed at another bank. Everything is transferable in kind, or that's not a problem. The main thing is you have to find the right person. So like you said, let's say you're 35, you're sold to your company $5 million. So already the fact that you don't know someone, and it happens a lot, by the way. I don't want you to think that it's an exceptional situation. Because a lot of people are often focused in their business. They don't want to know anything. And then when they sell, they're like, okay, now I have money. So now I could maybe qualify to have someone. And it's not true, because the bank has there's tiered levels based on how much you have, right? So let's say accounts under 200 grand, there's people at the branch, then 2 to 500,000, sometimes $1 million. There's people in financial planning, and then there's wealth management. Again, I don't want to say $1 million and plus, but those are the general guidelines to differentiate themselves. And the bank, like the way we work is that we're there to assist you along every step. So even if you started from the bottom, I don't want to say started from the bottom, but started from the bottom and you're slowly growing, as you're growing, we're continuing to grow with you, and we're putting you in front of the right people to help you. Because if you sold your business for $5 million and you come see me, or you see anyone, and your first question was, how do I know who to trust? Well, you'll get a feel. Like if you think the guy is just trying to pitch in to try to invest your $5 million and knows nothing else, doesn't ask you about you, your future goals, how did you make the money, tax savings, and what do you plan to do with it? And again, if he didn't ask you a million questions, he's probably giving you the wrong advice. That's my go-to line. So if you come see me with $5 million, you're 35 years old, do you really believe that one person alone could handle everything that you need? Like, do you think the accountant doesn't need to speak with the investment advisor? Do you think the lawyer who set up the business doesn't need to speak with the investment advisor? How to transfer that money from business to personal? Do we get a dividend? Is there tax? Is there a salary? Is there anything you put into business that we can get tax-free? The accountant maybe has different things based on how you set up the business 10 years ago. Everyone has to speak with each other. And it's the same thing on the other side. Sometimes accountants will give you advice without actually consulting anything. Could be the same with the lawyer. Could be the same in Quebec. There's no lawyer for trusts or estate accounts as notaries. But they'll set up something without actually knowing. They have cookie cutter portfolios, and they're like, okay, we'll do this because that's what most people do. And you want your investment advisor to say, hey, you know what? Give me the contact of your accountant. Give my number to your lawyer. Tell him to call me. You don't want to be stuck between those people. Everyone's telling you a different story, and you're trying to amalgamate everything, right? You want your advisor to speak with everyone and to give you the summary of all that. And we do meetings with everyone present. Because, I don't know everything about law versus the lawyer. I don't know everything about accounting. I know that when you speak to me about something, I'm like, oh, you should go see this person. You should go see that person. I know there's something wrong with what's happening, but I don't know the full details. And I'm not the one that's going to set it up. So kind of like generalist doctor, you just find red flags and you need to address them. So
by referring them to somebody who is specific.
Yeah, I mean, if I'm not the one that's going to, let's say your business, we figure out that we should open a holding and then do something with the whole, I'm not going to open up the holding,
Right.
I'll recommend it, but we'll speak with the lawyer and they'll do it. So it's really...
Okay, so then your general advice as far as choosing one is having a conversation with them, seeing if they ask you questions, and... I mean, at some point, it's going to become like a gut feeling. Like there's nothing that's going to jump out of his head and say, I'm a good advisor, right? You just have to... I don't know anyone that's going to say I'm not a bad advisor, right? They're all going to try to say that they are. But are they really there for your best interest? Okay.
That's the magic question that you need to ask yourself. And when you're sitting with an advisor, like if you feel like he's able to open up, you're connecting with him. You're not only talking about, fees or returns or tax, like there's more out of that. That's when you know that probably things are going good.
Yeah.
And, they should ask you, like, you sold your business for $5 million, for example. Okay. Like, what do you think about the near future? What do you want to do with the money? What are your plans with the family? Like, do you plan on leaving? Like anything that's like open-ended questions that's making you think about things that you never thought about.
Yeah.
So
That's interesting. When did you start this role? You say, okay, you graduated in
2016, and then I joined RBC
right away.
right away.
But you said you were an account manager. Is that what it was called?
Yeah, so I was an account manager. It's kind of like basic accounts, basic credit, basic lending facilities, and then
That's like the first tier.
that's like the first year, and then after a year, and then you have your mutual fund license, right? So you can only trade mutual funds. Then I went to senior account manager, so you do more complex credit, complex lending, business accounts, trust accounts. And after that, I went after about a year, also less than a year, I went as a financial planner. So financial planner, you're dealing with the mass affluent clients. Again, you're the relationship person. You manage everything that the client needs, whether it's banking, credit, investments. And then the highest level you can go to is the wealth management side. So wealth management, even if you have $100 million, $500 million, there's no higher level. You're part of wealth management and you get all the services that I described too.
Should I, as a young person, I guess this applies to anyone, but try and get as many credit cards as I can. Some people refuse all credit cards and other people have seems like they have 20. What are the pros and cons of getting a bunch of credit cards? Obviously, the one big con is you have now the capacity to bury yourself in debt.
Yes.
But are there benefits to doing that? Is it better to have many different credit cards or to have, let's say, one big one?
Very good question. So essentially, when it comes to credit, you're playing a game versus the credit score department, I guess I should say, which are there to help and not help you. So the best way to see is to analyze what they look for, right? So they don't want you to have too many credit cards because then they'll say you're a credit seeker. But then if you don't have any credit cards, they'll be like, oh, but if he doesn't have credit cards, that means no one gave it to them. That means there's something wrong. So that means he might not be trustworthy, right? So you want to prove to them that you're good in terms of what you can get, but you're also disciplined in terms of what you can use. So let's say you have 2 credit cards and each have, I don't know, one has a $1,000 limit and one has a $3,000 limit, right? If you're there's another ratio that they look for is credit utilization. So not only do they want to see that you have different products. So I would never suggest, let's say, more than 2 credit cards, maybe 3. Like if you have a Visa and then Visa doesn't work at Costco, so you get a MasterCard. And then for businesses, you have an Amex, let's say. Okay, but not multiple of the same. Each has to have a valid reason why you have them. And 2 for sure. You should always have at least 2 credit cards. One doesn't work. One you might travel, this and that. But then they check at the limits. So they want to see a big limit, right? So if you have 3 credit cards of $1,000, well, why did the bank give you $1,000? You're either low on income or there's something wrong with your credit history. But if you have 3 credit cards of $25,000 each, and well, that's amazing because if you got it, that means you're earning something to get those limits. And then they'll look at, okay, but he has $25,000 on each. What is he spending? So even if you were to spend, let's say you have a card of $25,000 and you spend $22,000 every month, and every month you pay it back, they'll see that you're paying it back. But they'll look at it like, this guy's using 90% of his limit. So the more I give him, the more he's going to use. Maybe that's not so good, even though he's paying. So that's why when the bank sends you an email credit limit increase, you should definitely take that because it's not a credit check. They're not asking you income documents, and they're automatically increasing it based on your previous history. So you want to have, let's say, 2 credit cards of big limits, low utilization. So if you're someone that spends $5,000 a month, you should have a $20,000 credit card, for example. Not $5,000. Oh, but my card is $6,000. I don't need more. Doesn't matter if you need more. They're going to look at it like you're using 90% of the limit. So someone who has, let's say, 2 credit cards of $25,000 spends $3,000 a month on each. Beautiful. Then he has a line of credit, $50,000. He doesn't use it, or he uses it once in a while. Then he has a mortgage and he has a car payment. Bulletproof. He has all different types of credit. Everything is utilized in a balanced way. Where it gets confusing is when people look at scores. You'll see someone with 1 credit card who has 820, and then you'll see someone with multiple lending facilities, all of them paid, and who has 750. Don't get too attached on the score. I know these new websites, they try to put you You'll see the TransUnion Equifax, and there's like a needle, an arrow,
Yeah.
and it shows you where you stand. Excellent, very good, very poor, poor. Anything over the 700s, like at some point, it's just sometimes like you'll see nothing change for you, and every month you'll have a different score. Just make sure that you follow those guidelines. You have more limits than what you use. You have a few types of credits, so credit card, loan, car, or a mortgage or line of credit, to show that, because a line of credit is harder to qualify, right? An unsecured line of credit is different than a credit card. A mortgage is different. A house is different. So you're using all of them efficiently, and the score is 750, it's 800, 820. They're going to look more at the history and see if there's any delinquencies. The worst thing you can do is have a late payment. And it doesn't matter what the reason is. You can try justifying a 10-page case on why you missed that payment. They don't care. Because if you couldn't pay that one payment, how are they going to trust you with the rest? So, and it happens sometimes. It happens so many times. People, before buying a house, they need it. And then they end up spending a year, 2 years trying to rebuild the credit. So banks are very, very analytical when it comes to looking at things. And they do exceptions. I'm not saying if you had missed a payment, then you'll never get a loan. It's just, why do it? How they are. You know that they're looking for something wrong in your case.
Yeah.
So might as well just do the right things, especially if you need credit. Right?
Yeah.
So yeah, good question when it comes to credit bureau. Again, the best advice I can give you, and from where I stand, going through all these different university paths, education, different roles I played at RBC. When people say, oh, you should really like what you do, you should love what you do, so you never work again. It's true to a certain extent. Like, I was always the person that's like, okay, I want to do something that I love, but it has to make sense, right? It has to pay me enough, right? If doing what I love gives me $30,000 a year, like, that's not where I want to be. So find the balance between both, but definitely try to remember that you need to do something that you don't feel like you're in a misery. You don't want to wake up with an alarm every day and be like, shit, I have to go to work. I really don't feel like it. Because you'll be capped. At some point, it's going to break it. Like, at some point, you'll be like, okay, I can't do this anymore. Then you're going to try to find something that's maybe, pays less, but is more convenient. And so figure out what your dream is, and figure out something that's going to pay you a decent amount of money that you're going to be comfortable with. If you're happy making $100,000 a year, perfect. If you need 300, figure out a way to make it. If you need 50 and you're comfortable, let it be.
Yeah.
Just make sure you're happy.
Yeah.
Because it's a long road ahead. You're 20, you're going to work for another 30, 40 years. You want to make sure that you're on the right path. And that's, having gone through those steps, I can tell you from now that, like, where I am today, and when I wake up, I have good days, I have bad days, I have terrible days, difficult days. But at the end, I'm like, this is what I want to do.
Yeah.
So, and I think
you don't see
for
yourself
students, particularly finding that, trying to envision that is very difficult, because even I didn't know how I was going to end up there. So it's ask the right questions, see the right people, shadow, ask around on how people did it. The best advice I can give you, again, is find someone who did it and ask him how he did it, if that will be, and he'll most probably help you out.
Yeah. So from what I kind of gather from that last thing you said, that young people don't need to, a student right now shouldn't necessarily already have their entire path carved out, but they should start asking questions, looking for what makes them happy, because ultimately that's where they want to end up, right? Like, they like you said, you don't want to be doing a job you hate for the next 30, 40 years. It's hard to be successful, right? If you're dragging your feet every day going to that job that you
won't, because there's a guy that's doing the same thing and he loves what he does, and at some point he's going to be better than you. He's going to put in more time, more effort, be more creative, and then there's nothing you can do to match him. So especially in today's world, everything's very competitive. Now entering travel, pretty much we're in a recession already. So it's not, last year a lot of people were shifting jobs, people were paying more. Now it's the opposite. So if you want to make it in a sustainable way, you have to always have in mind that even if you're a student and you have no idea what you're going to do, just make sure that you're doing the right steps, so that when you finish university and when you enter a new job, ask around. Like when I joined RBC, there's people that were doing my roles for 10 years, 15 years, the same role that I started.
Yeah.
But but what's next? So even if I knew that I didn't want to do that specifically, I always tried to see like 2-3 steps ahead. Okay, but if I do this, I'll have these 2 options open. And if I do that, I'll have these options open.
Yeah.
And then which one do I want to do? And then you don't want to also take 2 steps back. And I've taken 2 steps back to go 3 steps forward. But I walk costs, So
yeah.
Just be forward thinking, I guess. That's the only way I can put it. Like
Yeah.
I'm sure you have goals in mind. Like I'm sure what you want to do in the next 2-3 years is different than what you thought you were going to do and what you want to do probably in the next 10 years. But you don't just say, okay, like in 2 years, when I feel like doing this, I'm going to do it. You try to prepare in advance. You're like, okay, if I want to do this, let me ask this person. I'll try to save maybe this much amount of money in case the opportunity comes up. It's the same thing in school. Ask around.
Yeah. Thank you again for doing this. I think it's I think a lot of people will get a lot of benefit from hearing from you. And if ever you're a student and you start a business and you sell your business and need somebody to handle your wealth, we have a very good friend over here that is happy to do so. So I guess that's it.
All right. Thanks for having me, John.